Good morning, folks. This is Billy Trout with the Tennessee Department of Revenue's Taxpayer Education section. And on behalf of our Commissioner, David Geragino, and our staff in Taxpayer Services, and today our legal department, we want to welcome you to this presentation on legislative updates for 2023. We're glad you're joining us. We have a lot of people still joining, and we'll be getting into the material here in just a few moments. But first of all, I'd like to welcome Phil Fitzgerald with our legal department, and also Jeff Foster with our legal department as well. They'll be guiding you through the material today. And as always, our lovely and talented Katie Julian is here to keep us in line logistically, I guess you could say. So we're glad that Katie's on board like she always is. So with that, I'll go ahead and turn this over to Katie for a few little housekeeping things and a few reminders, as we do have quite a few people still joining and a lot of material to cover today. So Katie, thank you very much.
Great. Thanks, Billy. And thanks to Jeff and Phil for being our special guests today. I always look forward to this information every year. I learn so much. We are excited to have you all joining us. We've got a ton of people joining as we speak still. So we'll get started in just a minute. We've got a lot of material to cover. We may not have time for questions for this webinar, but I just want to go ahead and point you to the bottom of your screen right now, the information you see there, and we'll repeat this at the end of the webinar of how to get in touch with us if you have any questions about anything Tennessee tax related, or specifically about issues that arise from this webinar. You can email us at revenue.support@tn.gov or call our tax call center at 615-253-0600. And also, we will go over a little bit more information at the end. But if you want to request CPE credit for this webinar, there'll be a survey at the very end once you leave the webinar that will ask you a question about if you want to receive CPE credit. So just covering that real quick. Also, if you want to follow along with the slides for this presentation, you can go to our tax webinar page, www.tn.gov/revenue /taxpayer-education/tax-webinars. That link is also on the page you see right now. That's how you can get a PDF of today's presentation. And then also later today or by tomorrow at the latest, we'll have a recording of this presentation posted there. So without further ado, I'm going to pass the reins over to Mr. Phil Fitzgerald. Phil, you have got the reins to now proceed through the slides here, and I'll hop off and see y'all in a little while. Thanks.
All right, thank you, Katie, and thank you for this opportunity. Hi, guys. My name is Phil Fitzgerald. I serve as the Associate General Counsel for the Tennessee Department of Revenue. I joined the department in 2020. I represent the department in administrative matters, and I serve as the rulings editor for revenue and letter rulings. I provide research and guidance on all manner of state tax laws. I'm a graduate of the University of Memphis and the Belmont University College of Law. Also presenting with me today is my colleague, Jeff Foster. He serves as the Senior Tax Counsel in the legal office here. He represents the department directly in administrative matters, and he's involved in virtually all major compromise and variance requests. He has expertise in franchise and excise tax and sales and use tax, as well as tax incentives. Now, prior to working at Revenue, Jeff clerked for both the Alabama and Tennessee Supreme Courts, and he had his own practice for several years prior to joining the department in 2007 as a hearing officer. Jeff is a graduate of the University of Tennessee, Knoxville, and he received a BS in finance there and later received his law degree from the Cumberland School of Law. And so today we are going to present on some legislative updates for 2023. And this year there was some new legislation impacting the Department of Revenue. That included the Tennessee Works Tax Reduction and Jobs Investment Act, the Brownfield Tax Credit expansion, some additional sales tax on Delta 8 products, the Transportation Modernization Act. Additionally, there were some sales tax legislation that was scheduled to sunset that was not renewed. The gun safes and gun safety devices sales tax exemption is no longer available. That is sunset. Additionally, the vendors compensation deductions has also sunset. The vendor compensation deduction was a sales and use tax deduction to compensate dealers who were registered in Tennessee, and it compensated them for the accounting and remitting sales and use tax. The dealer was eligible for a vendor's compensation deduction that was equal to 2% of the state tax due, not to exceed $25. But that deduction was available for timely filing and paying the taxes due, but that deduction has now sunset as well. Public Chapter 53. This expands the industrial machinery exemption to apply to materials purchased by contractors to complete wastewater treatment projects at the mega site. This was a Department of Revenue administration bill. It amended the definition of industrial machinery. Previously, the exemption applied to contractors performing contracts for a county, municipality, or wastewater treatment authority as they were completing work for a pollution control facility. And this one adds the general services for the mega site to the list of public entities with whom a contractor can be working. The Mega Site Authority of West Tennessee provides services for the operation and development of the mega site, and they are attached to the Department of General Services. And if y'all didn't know, the mega site is currently working with the Ford Motor Company on the development of Blue Oval City, and that's where Ford is going to be making the electric F-150s. So Public Chapter 449, this one exempts certain trailers that are removed from Tennessee within 3 days of purchase, and it exempts them from the sales and use tax. This expands the 3-day removal to trailers used for non-commercial purposes. Now, there's an existing sales tax exemption for motor vehicles that are sold and then removed from Tennessee within 3 days. And so this public chapter expands that exemption to trailers that are not used commercially. And previously, any trailer used for commercial purposes did qualify. The definition of trailer is found under TCA 55-1-105. It's broad but fairly clear, stating that a trailer means every vehicle with or without motive power other than a pole trailer designed for carrying persons or property and for being drawn by a motor vehicle, and so constructed that no part of its weight rests upon the towing vehicle. So that's a fairly clear explanation. This bill was brought by a trailer retailer located on the Tennessee and Mississippi line, who claimed that he was losing business to retailers in Mississippi. He advocated for the bill, saying that he would get more business if his customers, most of whom had come from out of state to buy in Tennessee, didn't have to pay the Tennessee tax. One last thing, we've updated the 3-day affidavits on our website to now include personal use trailers that were intended to be covered by the expanded exemption, so you can download and print those off from our website. Public Chapter 467. This extends the repossession credit to dealers principally selling used cars at retail if the dealer assigns the security agreement or other title instrument to an affiliate finance company. Now, the dealer must satisfy specific eligibility criteria, and the department must verify such criteria is met before the credit may be claimed. And that criteria is the dealer must principally sell used cars. There must be a down payment that averages a maximum of 5% of the sales price of the vehicle. The dealer has to assign 100% of its security instruments to the affiliate finance company. And the dealer must advance from its own funds the sales tax amount on each purchase. And the dealer must reimburse the finance company for sales tax the company cannot collect from the purchaser. Some other useful notes: a finance company is an affiliate of the dealer if the finance company controls the dealer controls the finance company, or they are under common control. Control means the possession, direct or indirect, of the power to direct or cause the direction of the management or policies of a person, whether through the ownership of voting securities, contract, or otherwise. The affiliated finance company must also have the right to repossess or enforce any lien against an automobile for which it finances. If I recall correctly, there were some issues in previous iterations of the applicable statute here of this repossession exemption, that there were some issues with dealers and their affiliate finance companies missing out on the repossession credit because I think the repossession credit statute didn't contemplate the affiliate structure. And so to alleviate dealers from missing out on that repossession credit, this public chapter was passed. Public Chapter 480. This clarifies that beginning in January 1st of 2027, admissions to amusement recreation activities conducted at a facility owned by a sports authority during a time period in which the authority receives a special sales tax allocation are subject to the amusement tax. Currently, admission charges are exempt if certain nonprofit entities control the entire event. And beginning in 2027, this exemption will no longer be available to events as described. I've been told this was a bill brought by the Tennessee Titans, so I'm going to speculate that in the future there may be some large to be announced event at Nissan Stadium. So keep your ears open for that. Next up, got Public Chapter 423. It establishes a new 6% sales tax for the privilege of engaging in the business of selling products containing hemp-derived cannabinoid. Now, this tax applies in addition to the standard 7% state sales tax rate and the applicable local option sales tax rate. So I'm just going to say that one more time. This is an additional tax on top of the state tax and the local tax. This is an additional 6% tax. This tax does not apply to hemp-derived fiber, grain, or topical products. This is more applicable to, I guess, things that people would ingest: beverages, cookies, gummies, vapes. It applies to Delta 8 products and certain other derivatives. It also includes products that are made with Delta 9, but it can only be 0.3% of the product can be Delta 9, and that's 0.3% by dry weight of the product. And I'm not a chemist, and I can't really explain to you the difference between Delta 8 and Delta 9, except I think Delta 9 is the stuff that in larger quantities is illegal. It is reported, this new tax is reported in the same manner as the sales tax, so it's due monthly. And to help in reporting and paying the tax, the department has updated its sales and use tax returns to add Schedule H to report sales of cannabinoids. So the department has also published a recent important notice regarding this law, and it has updated its sales and use tax manual, if you want to get into the details. This public chapter will be enforced by both the Department of Revenue and the Department of Agriculture. But the Department of Agriculture is going to be handling licensure of suppliers and retailers. They're going to oversee manufacturing and distribution, compliance with labeling, product testing, and transportation requirements. The Department of Revenue is going to be responsible for ensuring that retailers are in compliance with applicable tax provisions, obviously. The Department of Revenue will also have enforcement responsibilities on the retail side of things. The department is required by this public chapter to conduct inspections at the retail locations where such products are sold and to confiscate non-compliant hemp-derived cannabinoid products that are available for sale. And that's, that could be products that don't meet the labeling requirements, are displayed incorrectly, or for whatever whenever they're found to be non-compliant with Public Chapter 423. So any questions you may have involving the manufacturing of these products and the licensing, compliance with labeling and testing, I'll guide you to the Department of Agriculture for those. If you have any questions regarding the tax or compliance on the retail end of Public Chapter 423, then you can reach out to the Department of Revenue. Public Chapter 86. This creates a tax credit for brownfield properties in Tier 3 and Tier 4 counties that is based on the remediation cost. The maximum value of this credit is $500,000. The credit may offset up to 100% of franchise and excise tax liability. The unused credit may be carried forward for 25 years. I will say that the 25-year credit carry forward was not included in this specific bill, but it was in the Tennessee Works Tax Act. If this credit is in addition to the already existing brownfield property tax credit that is based on the purchase price of the brownfield property. This was a Tennessee Department and Environment Conservation Administration bill. It seeks to address and incentivize activity in Tier 3 and Tier 4 counties by creating an additional credit based on the actual cost to remediate the site, to fix the site. Brownfield properties in these counties are generally less expensive, and the credit based on the purchase price doesn't necessarily incentivize cleanup in those areas. And so this provides a credit based on cleanup costs. Tier 1 and Tier 2 counties will continue to be eligible, but just for the brownfield credit based on the purchase price. Just a note here on, if you have a question what brownfield properties are, they are properties that have been used for industrial or commercial purposes that are contaminated with hazardous substances, pollutants, or contaminants. Tier 1, 2, 3, and 4 enhancement counties are a designation by the Department of Economic and Community Development, or TDEC. TDEC bases its classifications on unemployment in that county, the per capita income, poverty levels, and they use statistical agency data to compile that. And they publish a list every year of what qualifies within the Tier 1, 2, 3, or 4 counties. Public Chapter 159. This public chapter increased the registration fees for electric and hybrid vehicles. So for January 1st, 2024 through December 31st of 2026, the registration fee is $200. From January 2027 through December of 2027, that fee is $274. And thereafter, it's $274 and then adjusted annually for inflation. The hybrid and plug-in vehicles also have a different schedule. They From January 1st, 2024 through December 31st, 2027, the registration fee is $100, and thereafter it is $100 adjusted annually for inflation. These registration fees will be allocated in the same manner as the gas tax. This public chapter was a Tennessee Department of Transportation Administration bill as part of their Transportation Modernization Act. Last year, the Tennessee Advisory Commission on Intergovernmental Relations was looking at and making suggestions on electric vehicle registration fees. Essentially with the to try to get ahead of this potential loss of revenue from having electric vehicles on the road that aren't using gasoline, and we get a lot of very specifically allocated funds that are coming from the gas tax, and so this kind of gets ahead of that. The gas tax allocations are as follows: 63% goes to the highway fund, 12% to municipalities, 22% to counties, and 3% to the general fund. So quite a bit of money is going to basically the highways, and then counties and municipalities. The Tennessee taxes gas sales at 26 cents a gallon, and so with more and more electric vehicles on the road, there would be less money for upkeeping those roads, and this just kind of plugs that hole. Public Chapter 28. This eliminates the requirement that for inheritance tax purposes, the department be notified of the death of the last surviving lessee of safe deposit box if that person dies after December 31st, 2015. This seeks to add clarification regarding notice requirements for the inheritance tax. So although the inheritance tax was repealed December 31st of 2015, the Title 45 statute on safe deposit boxes did not specifically state that this notice requirement was no longer applicable for persons that pass away after that date. So this is a cleanup bill brought by the banking industry. It just aligns notice requirements for these safe deposit boxes with notice requirements for other types of financial accounts, which those accounts already had the 2015 repeal date specifically referenced in the statute. So this just evens everything out. So Public Chapter 370, this prohibits the state from imposing the litigation tax on adoption proceedings in Chancery Circuit and juvenile courts. That's fairly self-explanatory. So if you have a adoption proceeding going in Chancery Court, you no longer have to pay the litigation tax. Public Chapter 455, this establishes new caps on aviation fuel tax remittance for licensed air carriers with a transportation hub in Tennessee. Through June 30th of 2023, that cap is $5 million. July 1st, 2023 through June 30th of 2024, that cap is $3 million. July 1st, 2024 and thereafter, the cap is $1 million. This change builds off prior caps on sales tax for aviation fuel. These caps were established in 2015 and 2021. It further limits the amount of sales tax that any one taxpayer will remit. It applies only to those carriers that have a transportation hub, and the transportation hub is defined in the statute. And that's going to conclude my side of the presentation. At this point, I'm going to hand things over to Jeff Foster to bring it on home.
Thank you very much, Phil. That was very informative, and thank you everyone for tuning in. It's a pleasure to speak to you today. As Phil noted, I'm going to take you through the high points of the Tennessee Works Tax Act, This act contains major changes for franchise excise, business, and sales and use tax. I think it's a very significant package of tax legislation, and perhaps even the most significant since the RMA, the Revenue Modernization Act, was passed in 2015. There are three primary goals associated with the act. And first is to increase the Tennessee's national economic competitiveness vis-a-vis other states. The second is to provide tax relief to Tennessee businesses. And the third major goal is to provide tax relief for Tennessee families. And as we go through this, we'll see how this plays out and give you some examples of how those goals are fulfilled or hopefully fulfilled by the act. So let's start with the F&E provisions. The first and indeed probably the major provision for franchise and excise tax is that it adopts a nearly universal single sales factor. But before we get into the nuts and bolts of that, let me give you just kind of can't help myself, an income tax lawyer here, but let me give you a little bit of background about this issue. So the original apportionment formulas that were enacted by the states way back in the 50s and 60s that were based on the Model Act, the UDIPA, had equally weighted factors of property, payroll, and sales. And again, that was based on UDIPA, Model Act. A lot of states adopted it. But over the last several years, and really 30, 40 years, states have begun moving toward formulas that are more heavily weighted toward sales or receipts. And the thinking behind this is that this type of formula would more accurately and fairly represent the market for the taxpayer's goods or services. And there's also the idea, although it's not technically correct, that basing a tax, an income tax or a property tax on property would be a species of double taxation, you know, if the taxpayer is already subject to the ad valorem property tax. So the states began going this way, began moving away from payroll and property. And Tennessee followed suit. Several years ago, we went to a double weighted sales factor. And then in 2015, as part of the RMA, triple weighted the sales factor. Also, in 2017, we adopted an election, a single sales factor election for manufacturers. So many states, however, have followed this trend to its complete logical conclusion and have enacted formulas that are totally comprised only of a single sales factor. And in fact, 32 other states have done this. So this year, Tennessee followed suit. The act provides for a single sales factor and a 3-year phase-in period. So for 2023, the sales factor will increase to 5 times. In 2024, it will increase to 11 times, with the full single sales factor taking effect in 2025. So let's talk. So
hey, Jeff.
Yes.
Hey, sorry to interrupt you. Will that basically be per their tax year ending in 23 or 24, 25 as opposed to a calendar year end?
Yes.
Or do you? I was kind of thinking that. I just wanted to be sure. Thank you.
Yes, that's correct. And there's also in terms of calculating the tax year end for taxpayers with the 52 to 53 week filer, we'll treat them, say someone ends on January 29th or January 2nd, we're going to treat them as if the year end is December 31st. So let's talk about some special circumstances that are in the law. As I mentioned, and as most of you probably know, manufacturers have had the option to elect the single sales factor since 2017. Manufacturers that have made that election will continue with it despite the phase-in period. So they'll continue as before, manufacturers. There's certain entities that sort of stand alone for financial institutions and captive REIT affiliated groups. They will continue to apportion as before. The FIs with their single receipts factor and the captive REITs as set forth in the statute. And again, I called it a almost universal single sales factor. It will not apply to, quote, qualified members of qualified groups as currently defined by the statute. And these folks will continue to use the three-factor triple weighted sales factor. And this is basically the telecoms and the cable programming providers that have a special carve out for their apportionment. One other thing to note is that taxpayers will have the option to use the three-factor triple weighted formula if the application of that formula would result in a higher ratio and the taxpayer has net earnings. So you might ask, well, why on earth would anyone do this? Why would they choose to pay more, to have a higher ratio? And well, the reason is if they have tax credits, job tax credits, industrial machinery credits that they want to use that might be expiring, this allows them to make that election in order to use those credits. So this is a very, very major development for Tennessee. It goes along with the national trend. And so I wanted to tell you all about that here. Another one, it's a bit more of a niche provision, deals with the changes to the certified distribution sales election. And that is set forth in section 67.4, 2023. So the election in general provides, as it stands today or before this act, provides that taxpayers making sales of tangible personal property to distributorships in Tennessee of at least $1 billion annually and that have a sales factor of at least 10% may elect to exclude the certified distribution sales from the numerator of the receipts factor. And these certified distribution sales are those made to a Tennessee distributor and that are then resold outside of the state. Now, the taxpayers get to exclude these from the numerator, but they pay a special tax on these sales. That came in a few years ago in 2015, I believe. So this year, we see some changes to that. Now, affiliates can make an election for the group. And the certified distribution sales, instead of just being limited to TPP, will include alcoholic beverages. And the law also provides for a change in the election criteria. Now a sales factor of at least 7.5% is required, and it must be more than 50% of Tennessee sales are the certified distribution sales. So we're expanding this treatment just a little bit to capture some new taxpayers. Another extremely important development here are some new standard deductions for both franchise and excise tax. And these are for tax years ending on or after December 31st, 2024. For the excise tax, we have a new $50,000 deduction from net earnings. And this applies pre-apportionment. And it can't create a loss. For the franchise tax, we now have a $500,000 deduction from the minimum measure. So that's 67-4-2108. It's set forth on Schedule G. So you get a $500,000 deduction, the taxpayer. So again, this in keeping with the stated goals of the Act. It's trying to provide tax relief for business and to make good on the administration's promise to make Tennessee ever more business friendly. In staying with the theme of more business-friendly tax environment, we have new changes related to the federal bonus depreciation. So that came in federally in 2002 and allowed accelerated depreciation. Many years ago, maybe even from the get-go, Tennessee decoupled from this. And that means, most of you know, Tennessee starts calculating net earnings with federal taxable income and then either deviates from that in the statute if we do. So many years ago, we decoupled, meaning if a taxpayer took the federal bonus depreciation, the federal return, they had to add it back for Tennessee purposes. That's been the law for many years. This year, we reversed course and, if you will, recoupled with the federal bonus depreciation for assets purchased on or after January 1st of 2023. The Act specifically provides that the bonus depreciation will be applied for Tennessee purposes as it is under the Tax Cut and Job Act of 2017. The federal act, the major income tax overhaul of several years ago for federal purposes. And under the TCJA, the applicable percentage of the allowable bonus depreciation are as follows. You get 80% in 2023, 60% in 2024, 40% in 2025, 20% in 2026, and going to zero for 2027 and beyond. And again, this is another example of a taxpayer-friendly legislation that is designed to make Tennessee even more business-friendly. Another new provision this year deals with the paid family leave tax credit. So this is a 2-year pilot program running from 2023 to 2025 that matches the federal credit. So it establishes an F&E credit equal to that allowed under Section 45S of the Internal Revenue Code. But there are some qualifications. It's only with respect to compensation paid to qualifying employees in Tennessee during the tax period. And the compensation will be deemed to pay in Tennessee if it would be sourced to Tennessee under the applicable sourcing provisions for payroll set forth in 67-4-2012. So again, this is a taxpayer-friendly provision and designed to follow the similar federal credit. Sort of continuing with our theme of taxpayer-friendly provisions is a new provision dealing with the credit carry forwards. I think Phil, when his presentation, when he was telling you about the new changes to the brownfield credit, mentioned this. And current law for most tax credits, F&E credits, provides for a 15-year carry forward period. So if you hit your limit as far as the tax that can be offset in a particular year, you can carry forward for 15 years. This year, this act extends that and provides that the carry forward is going to be 25 years for certain credits. And these are industrial machinery, brownfield, the community investment, the qualified production credit for films, the new paid family leave, and the jobs tax credit. So again, we're seeing an attempt by the legislature and the administration to make to create an environment that's even more friendly for taxpayers and businesses. So that is it with regard to our F&E provisions in the Act. It also contains some very significant changes with regard to the business tax. So under prior law, you had the tiered system that everybody's probably familiar with. If you had less than 3,000 of gross receipts per year, you didn't have basically any license or filing. If you had between 3,000 and 10, that triggered the minimum activity license, and the 10,000 or above was the standard license, which required a full filing requirement. So this year, the Act came in and increased the threshold for the standard license from 10,000 to 100,000. And this is going to be determined on a per jurisdiction basis. So one of the corollaries of that, if a taxpayer has multiple locations in a single jurisdiction, it should get a license for each location and then combine the gross receipts to see if the threshold is met. So this is a major change. We think that this will mean 140,000 taxpayers will no longer be required to file the business tax because they'll be under the threshold. And the clerks, we've instructed them to begin now issuing the business license based on the $100,000 threshold. We were talking before the presentation, there's still a number of administrative issues to iron out with this, but just know in general that this is again the administration, the legislature trying to ease the tax burden on businesses and make it easier to do business. One of the major changes that goes along in the business tax deals with how manufacturers are treated. So under current law, or the law before the Act, a person manufacturing from a location subject to the Tennessee local property ad valorem property tax and making sales from that location was exempt from the business tax. And that made sense back in the day because the business tax historically was a local tax that required a location. It didn't have the nexus requirements it wasn't treated like an income tax or other tax that are nexus based. Of course, that has changed over the years, and the manufacturer's exemption was problematic. So now the exemption has been extended to out-of-state manufacturers, and it has been expanded to include not only sales made from the manufacturing location itself, but from a storage facility within a 10-mile radius of the manufacturing location. So again, an attempt to modernize the tax in light of changes over the last several years and to put the out-of-state people on the same playing field as the in-state and to bring it in line with modern trends. One other noteworthy change with regard to business tax deals with rates. The Class 5A taxpayers that are your industrial loan and thrifts saw their rate decrease this year from 0.3% to 0.1%, affected for tax years ending on or after December 31st, 2023. So this was the highest rate out there. So this is really the reason why this was the only rate that was affected. So again, you see the legislature, the administration coming in, trying to modernize the law, trying to create a more tax-friendly environment for businesses. So finally, the act also contains certain sales and use tax provisions. They really fall in a couple of different buckets. And the first one I want to talk about deals with the ones relating to the streamlined sales and use tax agreement. As most of you know, that was an agreement, a uniform agreement that was created in the early 2000s, maybe the late 90s, in the hope of standardizing and making sales tax more uniform throughout the states, so it would be easier to administer and easier to comply with. So Tennessee in 2007, 2008, we adopted several of the SST definitions and some of the substantive provisions at that time. But then as time went on, the legislature and the various administrations began to get a little bit wary of fully adopting the Streamline Agreement because, as we all know, Tennessee is very heavily dependent on sales tax. It comprises about 60% of the revenue that we collect at the department. So then what started happening is the legislature started to postpone the effective dates of some of the substantive provisions that were scheduled to come in. We saw this happen several times over the years. They were typically 2-year push-outs. And so we saw this happening starting in about 2009. Every 2 years, the legislature would push off the provisions. So then in 2021, we came in and decided, well, enough of that, all of those, postponing things and all of that is enough. We're going to repeal all that and sort of clean up the code. So that's what we did in 2021. This year, we took another look at Streamline and decided that there were actually certain provisions that were very that would be easier to administer and helpful from a tax administration standpoint. And those really deal with destination sourcing, which is a very prominent feature of Streamline. For example, the Act adopts certain Streamline provisions requiring the destination sourcing of services. For example, the repair of tangible personal property of software, the cleaning of TPP, the installing of TPP or software. So basically what this means is if the service is performed in another state and then the product is delivered here or brought to Tennessee for use or consumption, the sale is going to be sourced to Tennessee. And this is a major change in the law because under prior law, it was going to be sourced where the service was performed. In a similar vein, you've got the sourcing of lease property. Under the Act, it adopts the streamlined treatment of that and provides that Tennessee tax will not be due on lease payments when the primary location of the tangible personal property moves out of state. And again, this represents a major change in the law because it used to be where the lease was really entered into. If it was entered into here, it was going to be taxable here, no matter what happened to the property. But this gets rid of that and adopts the streamlined treatment of that. So all these streamline changes are going to be effective July 1st, 2024. So just something to look out for as far as your reporting and compliance. The other major sales and use tax aspect of the act is the sales tax holiday on food and food ingredients. And as I mentioned in the beginning, one of the major goals of the act is to try to provide some sort of relief for not just businesses, but Tennessee families. And this is really the clearest example of that. It establishes a sales tax holiday on food and food ingredients, and it runs from August 1st of this year through October 31st of this year. So again, this is the legislature and the administration trying to provide tax relief for not just businesses, but families too. So that is all I have as far as the Tennessee Works Act. We have a few minutes for questions. So if you have any, please use the chat box to submit those. And it's been a real pleasure speaking with all of you today.
Thank you so much, Jeff and Phil. That was, as always, very, very informative. I love hearing the background of what the reasons why a lot of times these things came into play. And I did just turn on the chat. We do have just a couple minutes for some questions. I'm going to go ahead and also skip over to this slide. Just to let you know, since we've got so many people in here today, no way, excuse me, no way we can get to all the questions.
Right.
But here's how you can reach out to us right here in front of you right now.
I see a question in chat, guys, about the sales tax holiday on prepared food. And I think the quick answer to that is there is no sales tax holiday on prepared food. These are on grocery items. Do you agree with that, Jeff and Phil?
Yes, absolutely. It's limited to food and food ingredients. And prepared food is a different animal, and unfortunately, there's no holiday for prepared food.
Right. I think it was last year that we had a sales tax holiday that applied to restaurants. It was a very limited time, but that is not the case this time. And we do have the sales tax holiday, the regular sales tax holiday, coming up this weekend as we record this presentation today, the last weekend, full weekend of July every year by statute. So look for savings that you can get on clothing, $100 or less, school supplies, $100 or less per item, and then of course computers, $1,500 or less per item on that as well. So take advantage of that if you're hearing this within this time frame for the regular sales tax holiday.
I'm seeing a question here, a couple questions about the new business tax threshold. From Michael, just formed an LLC this year. Looks like you've already gotten a standard license. How do you change it to a minimal? I'll be honest with you, Jeff mentioned this, that we are still ironing out some details administratively of that, because this bill went into effect for the current tax year. So some of you may have already gotten a standard business license thinking you met that $10,000 threshold, right? Well, then the Tennessee Works Tax Act passed and changed that threshold. You're already sitting there with a standard license and therefore a business tax account. Just so you know, we will be informing all the taxpayers that are affected by this in some way, shape, or form. You will not be liable for business tax if you gross under 100,000. Now, how that's going to be administered, like I said, that's still getting ironed out, but we will be having a webinar in September, the last Tuesday of September. This monthly tax webinar will be dedicated to discussing the business tax law changes that came about and how they are going to be rolled out, so to speak.
Mhm.
So another question. Yeah, sorry, Bill.
Let me tag onto that one, Katie, too. Yeah, everything you just said was absolutely right. But also, if we have any of you that are taxpayers or representing taxpayers that want to proactively make that change, you're welcome to call us at our call center number that you see on your screen here, or send us an email. Give us your account number and let us know verbatim that you will be under the $100,000 threshold and that you wish to go ahead and convert now, we will make a note on our computer system, which effectively changes the status of that with the counties and the cities automatically. So they would just expect you to go ahead and renew a minimal activity license next year in lieu of actually paying a business tax to the Tennessee Department of Revenue. They receive that same information once we update it. So, but you don't have to do that right now. I'm not telling you you must do that, because like Katie said, we look to be able to do some things in our computer system that might make that a little bit easier for larger numbers of taxpayers. And that's what we're investigating right now.
You guys, since we are out of time now, I just wanted to take one moment to take you over to our website and show you where you can get a lot of answers to your questions, because with having so much information in such little amount of time to answer questions, we shared with you how to reach out to us. But if you wanted to dig a little deeper, both Phil and Jeff mentioned our tax manuals. I'm going to show you how to get there, because all of our sales tax, franchise excise tax, and business tax manuals have been updated to reflect the new law changes. From our homepage, tn.gov/revenue, if you click on tax resources and then, or hover over tax resources and then click on tax guidance. From there, over in the menu here, you can click on tax manuals. You'll see all of our tax manuals. You got business tax here, franchise excise, sales tax. For your questions that you've got that you've put in the chat here, you may be able to find the answer to it in the updated manual. But again, we have people on hand to answer your questions during business hours, revenue.support@tn.gov, and our call center number that you see in front of you here. And like I said, we are going to have another kind of follow-up business tax wise to legislative updates in our September webinar. Next month, let's see, I think I have this. Well, follow us on our socials. Well, I really highly recommend following us on socials if you are on any of these platforms, because we will update. We put our notices, important notices out there. We inform taxpayers of upcoming events, webinars like this, but really keep you abreast of what's going on in the department if you follow us. But this is what I wanted to get to. Our next webinar next month, the last Tuesday of the month on 8/29, is taxation of short-term rentals. For any new businesses or people here that may work with new businesses, our quarterly new business workshop, we just had one a few weeks ago, but we've got another one coming up on October 8th too. So register for that. You can go to tn.gov/revenue and then click on taxpayer education and outreach. From there, that's where you'll register for our webinars. You already went there to register for this one, or our new business workshop. So with that, we're right at the top of the hour, but does anybody have anything else to add? Jeff, Phil, thank y'all so much for doing this for us today and helping our taxpayers understand all these complicated changes. Phil, you're on mute.
Oh, I just said thank you for having us, Katie.
Yes, thank you, Katie.
I should say they're complicated. Some of them are
Pleasure as always.
complicated to me, maybe not to everybody, especially that F&E stuff. It gets me. Well, yes, thanks everyone. And thanks, Billy. Thanks, Stan. And we will see you next month. Fill out the quick survey as you're leaving today. And if you
Please
want
don't
CPE
forget to
credit,
check on the box for CPE if you need CPE. Very critical that you do that. Okay.
that's right.
Just a little reminder for you. All right.
All right. Thanks, everyone. Have a good one.
Thanks, everyone. Have a good one.